Hello everybody and welcome to this macroeconomic video on investment. So firstly, what is investment? Well, investment is defined as an addition of capital stock to the economy. So when businesses invest in money, they give money to buying more capital stock. So therefore they are adding capital stock to the economy. And this capital stock, or capital, can be two types of capital in this case. We can have investment in physical capital, so investment in machines, buildings, factories, conveyor belts, office blocks, all those kind of things which help us in production. So by buying more machines we are adding to the capital stock of the economy. Or this investment, this adding of capital stock, could be human capital, and human capital is either employing more workers, employing more human workers, or developing my current human workforce by education or training, so by training them, by training schemes. Now, factors affecting investment, so whether a business will invest or whether it won't invest. Profit margin. Firstly, if businesses aren't going to make a profit out of their investment, they won't invest, because all businesses are motivated by profit. Next is the rate of return. If businesses want a quick rate of returns, they want a quick profit back from their investment, but actually they predict they won't get it, then it's unlikely they will invest, because they're not meeting their aim of getting a quick profit back, a quick rate of return. Next, there is risk. So if there is a high risk involved with the investment, if there is a big chance it will go wrong, then businesses will not invest. Next is technological changes. So for example, if a company is considering investing in lots of iPads, it may take into account the fact that there is a new iPad coming out in 6 months. So therefore, by buying all of these iPads, it's probably not worth it in the short run. In the long run, they might buy the new iPads coming out in 6 months. So if there is rapid technology change, if technology is changing all the time, the businesses are unlikely to invest. And our next three are current state of the economy, business confidence and economic expectations. So if business confidence is low, say for example they're not selling as many goods as normal, then they won't invest because they're cautious about investing that money. They're scared that they might need to keep it back as savings just in case they get into financial trouble. Also, if the current state of the economy is bad, they are unlikely to invest because there is a higher risk they might not make their money back. Also, if the future state of the economy is expected to be bad, then they might not invest because again there is high risk they might not make their money back. And finally we have the interest rate, the cost of borrowing, in order to finance that investment. So if the interest rate is low, there is a low cost of borrowing, so therefore it's cheap to borrow that money. So therefore the businesses are more likely to invest because they can cheaply borrow that money and invest that money. However, if the interest rate is high, then it's more expensive to borrow money, therefore businesses are less likely to borrow that money and invest.